So the central bank was established at the end of 17th century, and basically over the period in 1800 actually the Bank of France was established, and then basically all of the European powers acquired these central banks over this period of the 19th century, and this became what was known as high finance. And this was a century of unusual peace in Europe among the European powers, not in the world. In the world there were huge numbers of wars going on, but these were all wars of colonization. The European powers did not fight among themselves. And Karl Polanyi says that this was because the high finance, they had very strong linkages across the capitals, and it was not in their interests to have wars between the powers. So whenever there was an occasion for war, they exerted their invisible power to make sure that some peace was negotiated. So in this period, in the 19th century, Disraeli said that the world is governed by very different people from what is imagined by those who are not behind the scenes. And Rothschild, who was one of the billionaires and controlled the Bank of England, said, I don't care who is on the throne of England, the man who controls the money supply controls the empire, and I am the man who controls the money supply. Today it's the same thing. The US President Obama made many campaign promises. One of them was that he would ban guns, and he could never do so because the armament lobby is far too strong. And similarly, he said that there was this outrageous deal negotiated by one of the senators who after and the deal was this, that the government, the biggest medical care program of government, will buy medicines only from US producers at whatever price they name. They will not even be allowed to negotiate the prices, and they will not be allowed to import. So if they charge $100 for this drug and it's selling for $10 in Canada, they cannot buy it. So this there's been huge and amazing things which have happened, like this Daraprim or Daraclor, which we sell for malaria, which is so cheap that it costs. It used to cost $10, and now it costs $300 or something like that. And there are many such examples where a very cheap, easy to manufacture medicine, which is essential for lives, has been raised to incredible amounts. Actually, insulin, people are dying because they cannot buy insulin, and the same thing which used to cost, same insulin which used to cost $10 is being sold at $700 or something like that. So this is the control of finance. Big pharma is very strong financially, and they control the parliament sufficiently to make sure that nothing against. So Obama had promised that he would get rid of this bill, but he was unable to do so. So the man who controls the money supply controls the empire. So looking at the Victorian era, the central banks were, the main function was to provide funding to the government, but in addition the banks were trying to maintain price stability and exchange rate stability. This was because these were true multinationals. The financiers, they had interests in multiple nations, and so that's why they were trying to prevent wars. And they wanted to make sure that the trade takes place at stable prices, and that prices are stable in each country, because that's also important requirement for trade. Now, as we have discussed, this means that the money supply is fixed by international considerations, and therefore it cannot adjust to domestic market. So that was no problem. I mean, allowing large amounts of unemployment in the domestic market was also something that was favorable and desirable for these high finance international. So the domestic concerns were sacrificed or in preference for the international concerns. So at that time also there were many theorists, Victorian era monetarists, and there were many philosophies about how the central banks should function. One important position was the debate was the bullionist versus anti-bullionist. So the bullionist said that the money should be backed by gold, and anybody who wants to demand gold for his money should be given gold. The anti-bullionist said that no, money should be backed by the real bills, the assets in the economy, not necessarily gold. One of the concerns was of the banks, central banks, was that the gold standard, how can this be reconciled with financial stability? Financial stability mainly meant prevention of panics and runs on banks, because everybody understood that the gold standard was actually a fractional reserve standard. There was never 100% reserve. So in such a situation, panics are always possible, and at any point, in fact, the banks could anytime all the people who had claims on the banks would show up at the same time, the bank would be unable to provide them with the gold because there were just not enough. So one of the tactics that was used by banks was the large old established banks. They could gang up on new entrants. If there's somebody who has started a bank, because banks was a profitable business, what they could do, and what was actually done on occasions, was that the banks would issue bills and it would issue checks, and the other big banks would just hold them. And then when they had accumulated enough, they would all, in collaboration, present them to the bank at the same time. And the law said that if you are presented with the law was designed to prevent fractional reserve, actually it was, and it said that if you get a bill, you must pay it right away, you should not delay. So this would cause the banks to collapse. So then there was a law which was passed saying that you can have a moratorium. You can say that, okay, I will pay, but for a certain after a certain period of time. So this was one of the ways to prevent the panics. In that time also there were some rules which were made for setting interest rates. It was kind of a prototype of a Taylor rule. And Bagehot rule. The issue was that it was debated that central banks should bail out banks which are in trouble, like if they are under attack. So it was clear to everybody that this bailout should not be given to everybody at all times, otherwise the banks can do anything. On the other hand, it was also clear that sometimes, especially like in this situation where the bank is under attack, the bank is fundamentally sound, but it has been. So in that case, the central bank should step in to bail out. So the rule for when should you act as a lender of last resort was discussed, and some guidance was provided. Now, one of the important doctrines which was used to carry out central bank business was the real bills doctrine, that basically just like, you see, the bank, the initial transaction was that the government provided an IOU to the bank, and then the bank monetized this debt. It would create money on the basis of this. So similarly, the checking account that we use is a monetization of debt. When I deposit money, then the bank acquires, well, not like that. When the bank gives a loan to somebody, they create an account for him, and in this account they say that any checks that is written by this person or written by somebody else on the basis of what this person receives, we will pay money for. So somebody comes in with a check for 1,000 rupees, the bank gives them cash, which is today's gold. Now this is a loan, so this cash, where is it coming from? Well, it is backed by this IOU that the man has promised that he will pay us in the future. So on the basis of this promise, I am giving money to third parties, and the backing of this money is the real bill, the promise of this person to pay. So the real bills doctrine says that any asset, you can issue money against that, but you should not create money out of nothing. As opposed to this, so basically the theory, the real bills doctrine says that if you follow this principle, that for every money that you issue, you have some real asset backing it, then this will not be inflationary. But that is actually false theory. But this is the reason that in the Great Depression era, banks did not undertake expansionary policy, because they said, well, yes, obviously economy needs money, but where will we get the money from? We have no real assets against which we can issue money. So the real bills doctrine was wrong. Basically, it assumes that the full equilibrium, or so once you are at full employment equilibrium, all the resources are available, so there would always be enough assets that you could issue loans against them. But if you are at unemployment, then you are in trouble, because there are real assets which are lying unused, and so this assumption that there will always be enough real bills to monetize to keep output is false. And when there was not enough money to go around, then there was deflation. Prices started falling. This is the debt deflation cycle.